Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Credo Technology.
If you find our talks useful, please consider subscribe, like, and comment underneath. And let's just get right into it today. We're looking at what I like to call the absolute foundational plumbing of the artificial intelligence revolution.
Right, the plumbing.
Yeah, and I use the word plumbing, very intentionally here, because if you look at the market right now, everybody's just completely obsessed with the AI chips themselves. The processors, those multi-million-dollar GPU clusters.
Oh, absolutely. I mean, the entire market conversation just seems entirely focused on who is building the brain of the AI, like the actual computing engine.
Which, makes sense on the surface. But here's where it gets incredibly interesting for you as a wealth builder. The real opportunity, like the structural, long-term wealth-building opportunity, might actually be in the hyper-efficient cables and the underlying connectivity tech that links all those multi-billion-dollar clusters together.
Yeah, people forget about the links.
Right. Think about it. A supercomputer isn't just one giant microchip. It's tens of thousands of individual processors. And for an AI model to actually train properly, those processors all need to talk to each other at the exact same time, without a single microsecond of delay.
Because, I mean, the computing power of a massive cluster is really only as good as the network that ties it all together.
Exactly.
If the network chokes, the processors just sit idle. And that core bottleneck is what brings us to the sheer financial gravity of what Credo Technology is doing right now. I mean, Wall Street is suddenly paying incredibly close attention because this company is in a hyper-growth phase that's, well, it's just difficult to ignore.
Really difficult to ignore.
Yeah. The demand surge for their specific type of AI infrastructure connectivity is frankly staggering. Like, to give you a sense of the scale, we can look at their third quarter numbers for fiscal year 2026. Their reported revenue of just over $407 million.
Wow. Which, just to put that into perspective for you, represents a nearly 52% sequential increase from the previous quarter. Just a massive quarter-over-quarter expansion.
And an absolutely massive 200% jump year over year.
200%. That's crazy.
Right. That is hypergrowth in the most literal sense of the word. But what makes this fundamentally different from your typical tech expansions is that this isn't a story about a company slashing prices to gain market share at a massive loss. Their profitability is actually expanding right alongside that top-line revenue.
Yeah, let's talk about that profitability.
They recently posted gross margins hovering right around 68.5%. Plus, management is guiding for another record in the fourth quarter, projecting somewhere between $425 and $435 million.
Okay, I have to stop you right there and just unpack those margin numbers, because that is where the traditional logic totally breaks down for me.
How so?
Well, I love the classic picks and shovels analogy for the AI gold rush, right? The people who consistently make the most money aren't the gold miners. It's the people selling the picks, the shovels, the tents. So Credo is clearly selling the picks and shovels.
Right.
But 68% margins in physical hardware manufacturing. That feels practically unheard of. I mean, hardware is historically a race to the bottom. It gets commoditized, competitors undercut you, and margins compress. So how on earth does a company selling physical cables and silicon chips maintain the kind of pricing power you usually only see with, like, a software-as-a-service platform?
It's the defining question for their valuation, honestly. And to understand those margins, we really have to look at the anatomy of their economic moat. Because they aren't just selling generic passive wires that you can bulk order from a dozen different overseas suppliers.
Right, it's not just copper wire.
Exactly. The product mix they offer is incredibly specialized. It's born out of highly proprietary engineering that solves a very specific physics problem inside these massive data centers.
I hear you, but I'm struggling to see how a physical cable company defends itself against reverse engineering, though. A software company has a moat because their code is proprietary and it's heavily integrated into a client's workflow. But a cable literally connects point A to point B. What stops a competitor from just tearing one open, copying the design, and selling it for half the price?
Well, it's the complexity of what's happening at the ends of that cable. Their moat really comes down to two foundational pillars. First is their CRDO technology, and second is their active electrical cables, which the industry just calls AECs.
Okay, CRDOs and AECs.
Right. Let's start with CRDOs, which stands for serializer and deserializer. When a modern GPU processes data, it spits out a massive amount of information in parallel. So think of it like a 16-lane highway packed with cars moving side by side.
Okay, I can picture that.
Yeah.
A massive wall of data moving all at once.
But you can't run a 16-lane highway of physical copper wires across a data center for every single server connection.
No, of course not.
It would take up way too much space, generate way too much heat, and be impossibly complex to manage. So Certus technology essentially acts as a hyper-advanced toll plaza. It takes all those 16 parallel lanes of data and squishes them down into a single, ultra-fast serial lane to travel across a single wire.
Oh, wow.
And then when the data reaches its destination, another Certus chip perfectly unzips it back into 16 lanes, billions of times a second with zero errors.
So it's basically compressing the data for travel, like a zip file.
Actually, it's not compression in the way we think of a zip file, because compression implies altering the data or maybe losing some fidelity to make it smaller. This is sequencing.
Oh, okay. Sequencing.
Right. It's taking items side by side and lining them up single file at unimaginably high speeds and then reconstructing the side-by-side formation instantly on the other end. And Credo's implementation of this technology is so power efficient and fast that they use it to build their active electrical cables. Right now, they hold a dominant 70% market share in the AEC space.
70%. That's huge. Which brings us to the actual cables themselves. If they are just moving data over short distances within a server rack, why are these active electrical cables so special? I mean, why can't you just use thick, regular copper wires? Or, if speed is the real issue, why not use optical cables with lasers? We hear about fiber optics all the time.
Let's break down the physical limitations there. Passive copper cables, just the regular ones without any smart chips inside them, they suffer from something called signal attenuation at high speeds.
Attenuation.
Yeah. Basically, as electrical data moves faster and faster, the metal wire itself creates resistance. The signal kind of loses its breath. Over high speeds, the data degrades so badly it just becomes unreadable noise by the time it reaches the other side.
So the data literally exhausts itself pushing through the metal.
Precisely. And the traditional alternative to avoid that exhaustion has been optical cables. So instead of shooting electricity down copper, you convert the data into light and shoot it down glass fibers using lasers.
Right. Because light doesn't suffer from the same kind of electrical resistance.
Exactly. But optical modules have a massive drawback. Lasers require an enormous amount of electricity to operate, and they generate a ton of heat.
Which creates a massive cooling problem for the data center.
And an operational cost problem, yeah. What Credo did with their active electrical cables is brilliant. They put highly advanced signal processing chips directly into the plugs at both ends of their copper cables.
Inside the plugs themselves.
Yes. These chips actively monitor the degrading electrical signal, and they act like a sophisticated megaphone. They boost, clean up, and error correct the electrical signal so it can travel further and faster over copper without needing to be converted into those power-hungry lasers.
Okay, when we talk about saving power in a data center, I like to use a megacity analogy. Think of a modern AI data center as a sprawling metropolis.
I like that.
The GPUs are the massive skyscrapers where all the heavy lifting in business gets done, right? They draw all the attention. The optical cables with lasers are like an airport network, super fast, great for long distances, but incredibly expensive to build and operate. Credo's active cables are more like the ultra-efficient superhighways, connecting the nearby skyscrapers together.
That's a great way to look at it. And replacing those short-distance airport flights with high-speed superhighways saves a staggering amount of energy. Credo's active cables offer up to a 50% power efficiency advantage over optical alternatives for short-distance connections within the server rack.
50%. That is wild.
Right. When you are a hyperscaler operating a facility that consumes as much electricity as a small city, cutting your networking power draw in half is literally worth its weight in gold.
See, that answers the margin question beautifully. They aren't selling the copper. They're selling the 50% power savings embedded in the smart chips at the ends of the copper.
Exactly.
But you also mentioned reliability earlier. With a system this fast, what happens if there's a hiccup?
Well, that brings us to their zero flap technology. In networking terminology, a flap is a momentary drop in the connection. Think about when your home internet cuts out for a microsecond. You might not even notice it.
Sure.
But in an optical network, lasers can sometimes flap. They might momentarily lose alignment or power. Credo's copper technology offers 1,000 times better reliability than laser-based modules.
Wait, if a laser flaps for a microsecond in a data center, Doesn't the system just resend the data packet like my home router does? Why is a single microsecond such a big deal?
Well, in a standard cloud server hosting websites, yes, it just resends the packet, but AI is fundamentally different.
How so?
In a multi-billion parameter AI training run, the workload is distributed across tens of thousands of GPUs that must operate in perfect lockstep synchronization. If one single connection flaps and a GPU drops out for a microsecond, the entire synchronized state breaks down. Yeah. The other 9,999 processors have to stop, wait, and figure out what went wrong. It can literally corrupt a training session that cost hundreds of thousands or even millions of dollars in electricity to run.
So a single microsecond hiccup in the plumbing can tank $1 million compute job.
That is the harsh reality. The hyperscalers, the Amazons and Microsofts of the world, they absolutely cannot afford downtime. And that is why Credo's moat is so deep. Once their reliable cables are designed into the cluster architecture, the switching costs to try a cheaper, unproven competitor are immense.
Yeah, no engineering manager is going to risk $1 million training run just to save a few bucks on a generic cable.
Exactly.
That makes perfect sense for the short reach connections. But I want to play devil's advocate here for a second.
Go for it.
Because if you read the broader industry literature, there's a general obsession with moving toward entirely optical networks. The feeling is that as data speeds move from 400 gigabits to 800 gigabits, and eventually to 1.6 terabits, copper is eventually going to hit an absolute wall of physics,
Right.
even with smart chips inside. Isn't relying entirely on a copper-based moat basically a dead-end street for the long term?
You've just articulated the exact bear case that has haunted this stock for the past few years, that pervasive narrative that copper is dead.
Right.
And this brings us to what I consider an absolute masterstroke strategic maneuver the company just pulled off to address that exact existential threat. In April 2026, Credo announced the acquisition of a company called Dust Photonics.
Dust photonics. So they essentially saw the optical threat coming and just bought their way into the market.
Yes. Rather than stubbornly fighting the trend and insisting copper could do it all forever, they acquired best-in-class technology to master the optical side of the equation. Dust Photonics specializes in silicon photonics.
Which is the very laser and glass fiber technology we were just talking about.
Exactly. This acquisition completely transforms Credo's identity. They are no longer just a copper specialist. They are now a holistic electrical to optical platform player.
So they can cover the entire megacity now. They provide the power-efficient copper superhighways for the short hops between skyscrapers. Now they own the high-performance optical airport network for the long hops across the whole data center.
That's the perfect way to look at it. It
Yeah.
neutralizes their biggest long-term risk by absorbing it. And the financial projections attached to this are highly significant. Management is targeting this newly acquired optical portfolio to generate over $500 million in annual revenue by fiscal 2027.
Wait, hold on. How much did they pay for Dust Photonics? Buying a specialized silicon photonics company cannot be cheap. Did they have to take on a mountain of high-interest debt to pull this off? Because, that would immediately crush those beautiful 68% margins with interest payments.
The price tag was roughly $750 million. But they didn't have to take on crushing debt because of the sheer financial health of their balance sheet. Leading up to this, Credo was operating with a fortress of a balance sheet. Going into early 2026, they were sitting on about $1.3 billion in cash and short-term investments.
You're kidding?
No, really. They fully funded this transformative $750 million deal with cash on hand without jeopardizing their financial stability at all.
That is insane. It's like a dominant electric vehicle maker buying up the absolute best next-generation battery startup with cash they just had sitting in the couch cushions. It is incredible. Their total debt-to-equity ratio has to be practically zero, right?
It's hovering near 0.01.
Unbelievable.
And their current ratio, which measures their ability to pay off all short-term obligations immediately, is well above 10. That indicates zero meaningful liquidity risk.
And it completely rewrites the company's total addressable market. I mean, they aren't just competing for the short-distance server racks anymore. They are competing for the entire data center's networking budget.
And you can see the market violently digesting this transformation right now. We are witnessing a real-time shift in how the stock is perceived. It's transitioning from being viewed as a steady value play in the copper space to a highly aggressive momentum stock.
Oh, for sure.
Just look at the explosive price action that happened on April 14, immediately following the acquisition news. Shares surged nearly 19% in a single day to hit around $163.
Yeah, I was looking at the trading volume on that specific day. day, and it was staggering. Over 18 million shares traded hands. For context, that is a 155% increase over their normal daily average. Plus, the options activity was off the charts, which tells you that traders are making highly leveraged, speculative bets on this momentum continuing upward.
Wall Street analysts have certainly caught the momentum too. Needham recently reiterated a buy rating and set a price target of $220.
220, wow.
Jefferies initiated coverage with a $175 target, specifically citing a significant disconnect between the current valuation and the company's newly expanded growth potential. The broad consensus target right now is sitting just over $204.
And institutional ownership is sitting at an incredibly robust 80%. So the big mutual funds, the pension funds, the smart money, they're holding on to this tightly.
Very tightly.
But if the smart money is pouring in and the analysts are universally praising the stock and the balance sheet is a fortress, I did spot one glaring red flag while looking through their filings that we really need to address.
Okay, what is it?
The insiders are cashing out. The CEO sold 50,000 shares recently, and the chief technology officer sold over 27,000 shares right around the time of the acquisition. What gives with that? If this company is truly the plumbing of the AI revolution, why are the chief architects selling their own stock?
It is a critical observation, and tracking insider activity is a core discipline for any serious wealth builder. But we really have to clarify the mechanical nuance of how executive stock sales actually work, because it's rarely as nefarious as it looks on a headline.
Fair enough.
When executives of major public companies sell stock, they almost never do it by waking up, looking at the stock price, logging into a brokerage account, and clicking sell on a whim.
Right, because that opens them up to massive insider trading liabilities if bad news drops the next day.
Exactly. Instead, they use what the SEC calls 10b5-1 pre-planned selling programs. These are mechanical, automated plans established months or even years in advance.
Okay.
An executive might instruct a third-party broker to automatically sell 10,000 shares on the first Tuesday of every quarter, or automatically sell 20,000 shares if the stock price ever crosses $150. These triggers execute completely blind to whatever the current news cycle or acquisition strategy is.
Oh, I see. So when a stock stair-steps from the high 80s up to over $160 like this one has, it's just tripping all those preset valuation wires along the way.
That's almost certainly what's happening here. It is usually far more about routine personal wealth diversification, paying taxes on vested options, and estate planning than it is a signal of lacking faith in the company's future.
Makes sense.
That said, you are absolutely right to monitor it. While a 10b5-1 plan explains the mechanics, insider selling is always a countercurrent that validates the need for caution, especially in a market driven by extreme momentum.
Which brings us to the reality check portion of this analysis, because we always have to objectively weigh the massive upside against the concrete risks. And trading at a trailing price-to-earnings ratio approaching 88 is steep.
It's very steep.
It's like walking a high wire without a safety net. At 88 times earnings, the market has essentially priced in absolute perfection. If they report earnings and have even a slight miss on that $425 to $435 million revenue guidance, or if those 68% margins contract even slightly, it could trigger a very violent correction.
Valuation is unquestionably the primary bear case right now. An 88 PE is a heavy premium. The rebuttal, of course, is the math of growth.
Right.
When a company is growing top-line revenue at over 200% year over year, that forward-looking PE ratio shrinks incredibly fast. The market is willing to pay a premium for hypergrowth. But beyond the valuation multiple, you have to look at operational risks, specifically customer concentration.
Yes.
Right now, a heavy reliance on just a handful of massive hyperscalers accounts for the vast majority of their revenue.
So if one of those giants, say an Amazon or a Microsoft, decides to radically change their network architecture or starts manufacturing their own custom cables in-house, it would blow a massive hole in Credo's balance sheet.
That is the vulnerability, yes. Though the Dust Photonics integration actually acts as a calculated mitigation against that exact risk.
Oh, because it broadens their offering.
Exactly. By expanding into the optical market, they significantly widen their potential customer base over time, making them less reliant on any single buyer. Looking ahead, we have a clear catalyst calendar to monitor. The biggest near-term event will be their late May or early June earnings report.
That's going to be a big one.
The entire market will be laser-focused on whether they actually hit that revenue guidance and prove they can maintain those margins while integrating a massive new acquisition.
And beyond the earnings, there's some very interesting speculative chatter floating around the industry right now.
Mhm.
Rumors about a potential deeper partnership with NVIDIA, specifically for back-end fabrics.
Yes, and this is where the long-term thesis gets really exciting. It ties directly into Credo's new Cardinal family of 1.6T DSPs.
Let's break that down for the listener.
Yeah.
What is a DSP, and what does 1.6T actually mean for a data center?
DSP stands for Digital Signal Processor. If the SerDes is the toll plaza organizing the data lanes, the DSP is the highly intelligent traffic cop managing the flow, cleaning the signals, and making sure complex data sets arrive intact over tricky physical environments.
Okay, got it.
And 1.6T stands for 1.6 terabits per second.
Which is incredibly fast.
To put that in perspective, at 1.6 terabits a second, you could theoretically transfer the entire digital contents of a major library in the blink of an eye. It is the absolute bleeding edge of networking speed required for the next generation of AI models.
So if the industry rumors hold true, and NVIDIA begins aligning more closely with Credo's specific DSP chips for these next-generation 1.6 terabit speeds, that isn't just a one-time sales bump. That embeds them into the dominant architecture for the next several years.
It would be a massive structural tailwind that virtually guarantees recurring revenue across the entire upgrade cycle.
So bringing all of these threads together, we have a company experiencing 200% growth. They are extracting software like 68% margins out of highly specialized physical hardware. They dominate the critical copper networking space, and they just bought their way into the future of the optical space with cash to spare. When you synthesize all of that, what is the final verdict?
The fundamental thesis gives this a highly bullish score of 9 out of 10.
A 9 out of 10.
However, the critical caveat is the time horizon. This is a multi-year hold, not a short-term swing trade. The conviction here is driven by the massive 1.6 terabit upgrade cycle happening in data centers worldwide, combined with the strategic brilliance of the Photonics integration. It is a structural foundational play on the physical future of AI infrastructure.
That is a phenomenal breakdown. So what does this all mean for you as you watch the market evolve? I'll leave you with this final thought to ponder as you look at your own portfolio. The software algorithms driving artificial intelligence might seem completely infinite. They can generate endless text, endless photorealistic images, and endless lines of code. But the physical power grids and the cooling systems running the massive data centers where these algorithms actually live are absolutely not infinite.
No, they're definitely not.
They are strictly bound by the inflexible laws of physics and thermodynamics. As you watch hyperscalers announce massive, multi-billion-dollar AI investments over the coming months, don't just watch the software companies. Watch the physical constraints. The companies solving the literal heat, power, and connectivity bottlenecks of AI, the ones building the ultra-efficient superhighways, are holding the keys to the future. Thank you so much for joining us for this analysis, and we look forward to exploring the next big opportunity with you tomorrow.